You guys wrote a really interesting note over the weekend talking about your full year review. The dollar is going to weaken even though you still see potential upside for other U.S. assets. Explain.
Well, investors in the United States, Lisa, have a tremendous home bias, and we don't think that is changing anytime soon. What we're really seeing is investors outside of the United States take a second look at their exposures to the U.S., both in terms of their asset holdings, but also in terms of the currency exposure that they have related to those asset holdings. So one of the things that we're expecting are investors outside of the U.S. to increase their currency hedge ratios, and that's not something that requires them to sell U.S. assets. They don't need to sell the money that they have in the S&P 500, but maybe they take up their currency hedge ratios, and that is one of the factors that we think will be putting downward pressure on the dollar over the next 12 months.
It's one thing if investors don't want to go into dollar-denominated assets. It's another thing, and I'm talking about international investors, it's another thing if they actually are trying to just hedge against the dollar. It's two different things, and there's this question about the bond market and whether these international investors are wary of parking their money there. How do you see a scenario where yields could go down? You could see a bid into the bond market even at a time of international flight from the dollar.
Yeah, well, this is exactly why we think that in this move to lower yields that we're forecasting, you have a very large curve steepening. In fact, it takes the shape of the curve to levels that existed the last time the dollar hit those lows that you mentioned earlier. So we are expecting the Fed to cut rates, not this year, but next year. We've got the Fed cutting 175 basis points next year. That is way more than you see priced into the bond market today. And that's one of the main factors that drives yields lower. But that move is primarily driven in the short end of the curve. So you get this very large yield curve steepening, and that's going to bring us back to levels that existed before the GFC, we think.